Is it raining by where you are too?
It sure is.
It's a lot.
Sure is. All right, we have our attendees rolling in.
Excellent.
We'll get started in 1 minute, Jason.
Sounds good to me.
All right, you're quite a draw here, Mr. Goldstein. Attendees, this is pretty much a packed house. So I want to thank everyone for joining. Good afternoon to our friends here on the East Coast, and good morning to the rest of the country. Appreciate you joining. Appreciate the banter the participants are shooting to Mr. Goldstein's direction through the chat. Understand it's a rainy Thursday at Augusta, so we may have a better attendance than expected. So, today's topic is a favorite of mine, volatility buffer, how to protect your clients, not just today, but 40 years from now against volatile markets. So, I preach this concept. I've held several webinars, but truth be told, Jason Goldstein was my instructor and introduced me to this concept, explains it, articulates it extremely well. Jason is a top-notch producer, will engage in joint work based on his expertise on this concept. So, anyone wants an introduction to Jason, I'm happy to share. But today, it's not a commercial about Jason. He's been kind enough to share his knowledge, co-present with me. I'm going to ask him some tough questions about volatility buffers. Yeah, I think the industry has caught on to your secret, Jason. Every time I turn around, there's a new marketing piece around, taming the bear markets and sequence of returns. And, I think this topic is now more socially acceptable. It's being taught at the American College. Dr. Wade Pfau has become the face of the mathematical course and the advanced the American College, and the RICP course. So, Jason, welcome.
Thank you very much for having me. Absolutely love doing this, this stuff. So love to reach out to as many people as possible. I see we have a bunch on the line. So just spreading the word, because again, it's not my opinion. It's just math and science, and I'm just, spreading the word. So that's why I absolutely love this stuff.
Yeah, the numbers don't lie, right? So Jason, I'm gonna jump right in. I'm gonna ask you some tough questions. So rather than go through a course type material today, I'm just gonna ask some pointed questions of Jason. He's gonna screen share some of his very best material to help articulate his responses. And again, the chat's open, so punch in whatever you're looking to know. So let's start out really basic, and then we're gonna graduate, Jason, where I'm gonna challenge you a little bit. So, in your opinion, you meet a Wall Street jockey, okay? They want to know what you do for a living. How do you describe what is a volatility buffer?
So I would say it's not the first thing that comes up, but it's something that should be discussed pretty soon, into the conversation. I think if you're talking to a Wall Street, person, they're mostly focused on accumulation, and that's fine. We need to accumulate during our working years. But when you are going through distribution, the math works very different. You are no longer dollar cost averaging, where you have, man and woman at work and you're turning income into assets. You are now turning assets back into income. And unfortunately, they don't teach people exactly how that works. And now they're just starting to teach the advisors. So a volatility buffer usually comes up when we ask the question, what's a safe withdrawal rate? And no one really knows that. They might have read about the 4% rule or something like that, but have they really tested it? And so we say a volatility buffer asset is really a non-correlated asset to the market to use in retirement when the market's down. not if the market's down, when the market's down. The market goes down every, 3 out of every 10 years on average. So what are you going to do when the market drops 10 or 20%? Are you going to still pull out your income from that same asset? That would be selling low. You're not supposed to sell low. But if you're no longer working, you don't really have a choice. You need to live. So it's good to have a non-correlated asset. And that is what a volatility buffer asset does.
Jason, give us an example. What is a non-correlated volatility asset? What can you use to perform this strategy?
So the strategy, it's not that we invented it. It's just we can show mathematically how it works. But for the most part, you can use a few different tools. So you could use cash and just have money sitting on the sideline. But cash is probably not keeping pace with inflation, so it's not that great of a choice, but it works. You could have bonds, but if you're selling bonds during a down market, if rising interest rates, you might actually lose money. You could use money market. You can use cash value life insurance. We believe cash value life insurance is by far the best buffer asset, because if you look at the conditional return, the IRR on the cash, years after you've sold the policy, it's probably running at about 5% compound, and somewhere between 3.5% and 5.5%. And it has a death benefit on top of it, both of which are tax-free. So it's really something that's uncorrelated to the stock market. But again, those 4 things, could be used.
Okay. So Jason, the bond market is arguably changing quite dramatically. And we've just experienced the worst quarter for bonds since 1976. Explain, you touched on it, but just give us a little more color. Why won't bonds work as a buffer asset as well as a cash value whole life or a low cost non-multiplier fixed indexed universal life policy?
I mean, simply put, we're in a rising interest rate environment. And when you are in a rising interest rate environment, yes, you might get better returns on bonds, but the actual balance you are, losing money on.
So you're eroding your net worth.
You're eroding your net worth. So we essentially had if you look back last 40 years, believe it or not, the bond returns have been slightly better than the equity returns over the last 40 years, which is kind of, shocking. But that's because we've been in a continually low interest rate environment versus the previous 40 years. Bonds were terrible because you also had a increasing interest rate environment like we're in right now. So bonds are somewhat inversely related to stocks, but they're not entirely free of risk. So essentially bonds, if you're using it to take out large sums of money, not just the interest or the dividends, you're probably not going to do too well. Okay.
So Jason, you carry the Mass Mutual card. It's real obvious you want to sell me a whole life insurance policy. Okay. Let's just cut to the chase. It's undeniable that the early years IRR on whole life is minimal. So why do you think the whole life is a better solution for me, being that you're a practicing life insurance agent, than I can do on my own? Why the whole life?
Well, specifically for a buffer reason, I mean, so when I go through selling life insurance, I pretty much call it life insurance 101, 102, and 103. Life insurance 101 is the amount of insurance that you should have to protect your family. Whether it's a multiple of income based on age or you do human life value exercise, you need to understand how much life insurance you need to protect the family. So we don't even get into the products. Life insurance 102 is the products. Why would term fit here? Why would whole life fit? Universal life variable. So we like to use whole life as an asset class, basically as a bond surrogate. But it's for the long run. It's not for the short run. So life insurance 103 is, how does owning permanent life insurance in retirement actually increase your income? Not by a little bit, but by 50, 70, even 100% over your current path. And essentially we're using the principles, of life insurance. I mean, what are the 2 guarantees in life, Anthony?
Death and taxes.
So wouldn't it make sense if we were to leverage those two guarantees to increase something while you're alive? I mean, no one likes to talk about death or taxes. I mean, people talk about taxes negatively, but let's actually use those principles to increase retirement income. And that's what we can show and prove, in here. So when we talk about whole life, especially as an asset class, we say, look, you're not really going to get much in those first few years. In fact, if you start to, look at your cash value in the first 2 or 3 years, you're going to be very upset or underwhelmed, because essentially the first 2 years of premium go to policy setup. It goes to pay your eventual death benefit. It gets paid in commissions. So you have a lot of the setup, but once you're in year 3 and 4, it really goes towards, mostly cash value. So my clients tend to not like their whole life policy for the first couple of years, but the ones that we talk about in detail, they know not to look at that in the first few years. Everyone's like, oh, there's a 10-year break-even period, 11 or 12. Let's actually just eliminate the first 2 years, knowing that is your actual sunk cost. Let's look at the conditional return from years 3 and on. It looks pretty good. So I am a 30,000, 50,000 foot planner, and essentially we want to look for the long run. So this is not a short-term, bond play. I mean, it's the same reason why you're putting in your 401k. If you're 30 years old, 40 years old, putting in your 401k, yeah, it stinks when the market goes down, but you're not touching that till 59 and a half anyway. You should really consider the whole life insurance the same way. It is for your whole life, not for the next few years. So you were looking at the long-term, play. And especially in retirement, you're looking at that conditional IRR. There's really nothing else, better that's out there. Not even close, in my opinion.
All right, so you have my attention a little bit. Now explain to me how, if I'm giving up yield and I have all these sunk costs, how is it possible that you're going to convince me that I'm actually going to live better in retirement by giving up the yield and giving you premium for whole life insurance?
It's really just all about understanding the math between accumulation and distribution. So you're right. What are you giving up by purchasing whole life? Well, you could use it for other things, especially you could use it, to buy equities. I'm not going to tell you that you're not going to do better in equities, right? But that's not what we're measuring. We're measuring retirement income. So if you're targeting, say, a 10% return in the equity markets for 30 years, okay, that's pretty good. In whole life, let's just simplify it and say you're going to get 4%. Okay, so you got 10% versus 4%. Well, now when you go to distribute, the equities will really only give you a 4% distribution rate at best. And we can prove that using what's called the Vanguard retirement nest egg calculator, which I'll probably share in a couple minutes. But you're going to get 4% on the distribution, side. But if you're using an actuarial concept with life insurance partnered with possibly an annuity, you're going to get a 10% roughly distribution rate. So personally, I want a 10% growth rate and a 10% distribution rate, right? So even if you're losing some of the growth on the upside, the distribution rate is so much higher that you're willing to take a slight haircut in your nest egg at retirement because your distribution rate far overshadows the fact that your assets may not be as high as they would have been if you just bought term and invested the difference. Does that make sense?
Yeah, Jason. So I think what I'm understanding is that there's two financial superpowers. You have the banks and the wirehouses who are chasing yield and accumulation, and then you have the actuarial science companies who are providing distribution. Is that what I'm hearing?
Yeah, and which one can be more accurate with their predictions?
The actuarial science.
Like almost deadly accurate, right? Because they're pooling risk. They're pooling millions of people together. So Anthony, you look like a young, healthy person. I have no idea how long you're going to live for, and neither do the actuaries. But if I had 1 million Anthonys, I could tell you within 2 weeks of when you were going to die, because it's the law of large numbers and it's averages. So as an individual, you pretty much have to plan for life potential because you could live a really, really long time. But if you think like an actuary, you can tap into your life expectancy, which is a lot shorter. So when we're talking about retirement, if you can tap into a shorter amount of time and you say you have the same amount of money, you can spend more per year if your retirement's only going to be, say, 18 years or 20 years versus 40. You don't know if you're only going to live 5 years, 20 years, or 40 years. So it's the principles of the insurance companies that have the information. It's boring, it's predictable, but it increases distribution rates unbelievably. And that's essentially how pension plans are built. It's a bunch of investments and an actuarial science concept. Social Security, there's a bunch of investments and it's an actuarial science or a life expectancy of the masses. Very, very predictable. What's not predictable is the market. So we take something that's unpredictable, risky, but most likely will go up in the long run, and something else that's extremely predictable. You leverage them together and magic happens, which is more retirement income.
So Jason, are you saying that when the Guardian guys at 140 Broadway fight with the Merrill Lynch guys at 200 Park, are you saying that there is no clear winner and that the client actually needs both of them to succeed?
I mean, that's exactly what I'm saying. So it would be nice if we thought about the client first and not what we're, perceived to be the best, solution. So I think oftentimes you have these investment guys that hate insurance, for whatever reason. I would say, let's say 90% of investment advisors hate, insurance. So they're going to fight and say, look, you're not going to get that high of a rate of return on the cash value of whole life. And look at how large these commissions are for, the producers. They're really not thinking about the client and saying, hey, maybe I should actually look at this and see from a retirement income standpoint, because we're not arguing the same thing. We agree with them. We say, you're right, it's not going to return that much. But what is your actual method for taking income later? How do you turn those assets back into income? And equally wrong is the insurance people that bash investments. I don't believe in the life insurance people that say, don't ever put money in the market. It's too risky. You should only buy permanent insurance. That's not right either. You're not going to get enough risk or growth, especially if you're trying to outpace inflation. So I want to take the best of the investment world, the accumulation side, and the best of the actuarial or insurance world, which is the distribution. And there's a formula for it too. Your investment rate science is more powerful the younger you are. I have no problem meeting a 25-year-old and saying, put all your money into investments and buy term insurance. Over time, we're going to convert because your investment rate power weakens with time. It weakens because you can't say, hey, the market's going to go up. You can tell a 25-year-old the market's going to be higher when you're 70 and look them in the eyes and say that, but you can't say that to a 66-year-old. If you're working with a 66-year-old, their investment rate science power is pretty weak. They've already gotten through those times. They really need the actuarial science side to get them down the mountain safely. And so that's the point. Whenever I meet with people, it's like, what's the perfect mix? Well, how old are you? What do you have so far? What's your cash flow? And when do you want to retire? Based on all that, I put it into the system and it spits out what's mathematically, accurate. You then obviously have to go through all the feelings. So it's not just the math. If we went with just the math, not everybody would move forward. So there's a change, that has to happen when you're talking to people. It's not obvious, but once you go through it, it's like, wow, okay, is everyone doing this? That's when you've done a good job.
Jason, that's a perfect segue. So what you've told me about this strategy so far is that I'm going to protect my family. I'm going to hedge against longevity, right? Life potential. And then I'm going to live better with higher distributions in retirement.
Yep.
What calculators, or what, you keep talking about the math, what calculators or methodologies or formulas do you have to support these types of statements?
So I'm going to share my screen in 1 second, and I use these on a regular basis. I did just notice there's a couple things in the chat box, and I just want to see if there's anything we need to mention right now. And we have a couple Q&A. We can also do that at the end. But I'll probably actually answer some of these questions. So let me just share my screen and I'll go from here. So when I talk to a client, this is the Vanguard Retirement Nest Egg Calculator. Can you see my screen?
Yes.
Okay. So I ask people, first I do an inflation adjusted retirement income. So if someone wants to make, $200,000 and they're not retiring for 15 or 20 years, I have them put that into a calculator to show what their retirement, is. Which we might do in a minute if we want to keep, going through this. But I then ask, let's just keep it easy and say their inflation adjusted calculator, they wanted to have $100,000 of income. Okay. I asked them, what do you think your net worth is? What do you think your investment account needs to be when you retire in order to produce $100,000 income for 30 years or however long they tell me that they think they're going to be retired for? And then I just stop talking. I let them, so the ones that kind of know the 4% rule, they'll say something like that. But I've had people say, well, the market, returns roughly 10%. So let's take a couple of percentage points off of it, and maybe I'll have like an 8% distribution. So let's do 1.5 million. That's a 6.7% distribution. Okay. I then say, all right, what is the mix you're going to use the day you retire? And some people are like, I don't know, or I think I'm going to have less in stocks, more in bonds. I let them kind of choose and move these toggles. And by the way, this is a free website. Everybody loves Vanguard. So I just give it to them. And I've had people play with this for 45 minutes after the meeting. It depresses people because you realize how much more of an asset that you need than you thought. But if I run this simulation, it will basically tell me that if I'm trying to pull 100 grand from a $1.5 million nest egg, I only have a 34% chance of success.
Ouch.
Yeah, it's not good. And if I go over here, it shows me the 50th percentile. I'm probably going to run out of money between the 18th year and maybe I'll barely be fine. But there's a 5% chance I run out of money in less than 12 years. I could also be pretty wealthy. It depends on the sequence of return. So once I say, is this acceptable? Then they're like, well, no. Okay, what do you want to change? Well, sometimes people change their lifestyle and they lower their income. But I try to say, no, let's keep that the same. Just tell me how much more you want, either more risk or how much more money you think you should have. And it's like, I don't know, let's try 2 million. Okay, fine. How does that work? Now they're up to 73%. Like, okay, better, let's try 2.5. So we kind of keep moving them along until they are comfortable with what the probability of success is. And then they get you pretty depressed. And you want them to say, all right, what do we need to do that's different? Because if they basically go all the way up to this 3 million, they're like, I have no idea how we're going to get there, but at least that's going to give us the comfort that we have a 97% chance of success. Then, okay, if you're meeting with an investment advisor, this is probably what they're going to say. They might say, hey, you know what? I can give you really good dividend paying stocks and we can get you a 5% withdrawal. Well, it's not going to work because this already accounts for everything. When you go through and you can look at sequence of return risk, which I'll show in a minute, you can show it in here. And this is actually a great tool. This basically says if you have $1 million and you tried to pull $75,000 out, adjusting for inflation, if the market returned 12%, you're gonna have more money at the end of every year. You're gonna have $6.4 million after 30 years. If you actually retired in 1973 and had all your money in the S&P 500, you would have gotten 12%. But it's all over the place. So this is not what would have happened. That's what would have happened. So even though this individual got a 12% return for 30 years, because the first 2 years were down 14 and 26%, they crashed and burned and ran out of money in 16 years. Not a good sequence of returns. So when your stockbroker says, hey, we average 10%, that's great. Average does not mean anything when you're retired if you have a couple horrific years. Because you're doing what's called reverse dollar cost averaging. You are pulling money out of the market instead of feeding it. So when you're working, it's okay if the market goes down, you're buying low. You're buying at all times. But when you're selling and you're retired, it's not good to do that when the market's down. It has like a double negative, which is bad. So we could pick another 30-year period, like 1954, also returned 12%, but because the sequence was really good, this individual did great. So what this shows is here's 10 different sessions of 12%, 30-year return periods. These two succeeded, these two almost succeeded, and these two failed. That is 10 simulations. This is 100,000 simulations really, really quickly. And so you actually will get a slightly different output every time you run this. So the interesting here is if you actually have a low distribution rate, if you do have a good sequence of return, you may accidentally have a high net worth, which would end up being other issues on the back end. So when we work with actuarial science to inject it, we're both looking at the distribution, but also legacy planning. Because I don't think people would be very happy if they left their kids all this money and they didn't, live the retirement that they wanted. I mean, maybe they do, but everybody has a different, approach to that. So this Vanguard retirement nest egg calculator is very, very powerful. I like people to use their own numbers in here because, and by the way, if they're comfortable with a higher, let's move this up to here, a 6% distribution, if they are comfortable with a 49% chance of success, that's fine too. Because if I incorporate a volatility buffer, they'll probably be able to take out 14%. So what I love about this, it doesn't matter what assumptions clients use, the two economic power approach of investments and insurance will always win. That's not my opinion. So I don't get into arguments. I just basically ask questions and try to prove it here.
Well said. Jason, one question from the audience is, how do you address taxes? Is this a tax neutral mathematical equation?
Yeah, it's tax neutral. But we obviously address taxes, but the bigger question here is really the interest rate and the mortality arbitrage. I mean, for the most part, you're betting that you're going to be older when you're older. So imagine you're 45 years old. You say, you know what, I bet you in 20 years, I'm going to be 65. Well, if you live that long, you're going to be correct. If you don't, well, at least you bought the insurance and your family was protected with a death benefit. If you're still alive at 65, you're going to make another bet. Your conditional life expectancy at 65 is going to be higher than when you were at 45. Okay. So you're basically making a bet that you're going to be older. You can't lose that bet. The bigger the spread between today and retirement, the better this strategy is going to work. The strategy that we talk about with buffer years, I mean, it still works if you're working with somebody that is retired. It doesn't work as well, but we like to use the arbitrage, situation. So as far as taxes, there's a good book that I have right here. It's called Tax-Free Retirement by Patrick Kelly. The only bad thing about this is that the life insurance chapter is actually about IUL. So, but other than that, it's actually a great book. But it talks about how do you have a tax-free retirement? Well, you should have muni bonds, cash value life insurance, and as much as you can into a Roth, because then you won't need to worry about things. So we bring the tax conversation into it after we show them the two economic power approach, because we can't control taxes. We just have to be prepared for any situation.
Okay. So that works. So the first piece of this mathematical equation you've established as the distribution rate, right? You've taught the client about distribution rate using their own assumptions, using a non-industry related third-party vendor such as Vanguard, who's primarily in the investment business, by the way.
Yep.
What's the next step in this mathematical equation where now you can introduce new formulas to further convince the argument that you're protected if you die too soon, live too long, and live a better life through distribution?
Yeah, so I really like to use Wealthbuilding cornerstones because I used to use Leap. I still use Leap. There's tons of systems out there, but at the bottom line is it's math. So whatever you can find the best program that will, deliver the result to the client in the simplest form, because some people will understand this right away, and a lot of people will not understand it until you go 2, 3, 4 meetings with them. So, the goal is to get people to understand this immediately. It's not always that simple. So wealth building cornerstones really gives you the, the tools that I believe are best set for this conversation. There are definitely other systems that still, discuss it, but so far this is the best one that I've seen. If something comes out in 2 or 3 years or sooner that shows this better, I'll use that. If I build something on my own that I think is easier, great. But I try to use, and I still use some other systems. So for this, I like to use wealth building cornerstones. So I'll give you an example. And let's see, if I go to these, and you guys can still see my screens, right?
Yeah.
Okay. So the first thing is return order and volatility buffer. Okay. So remember how I said in the Vanguard site, and the greatest thing is everything I say is repetitive over and over and over again, because people need to hear this. They're not hearing this on a day-to-day basis. So if I can make the same point and show it in 3 different systems, great. It must be true, right? As long as they trust me and believe in everything. So this is a good quick, it's basically 2 slides. All this is saying is you retire in 1970. Let me make this a little bit bigger. You retire in 1970 and you tried to live off of 75 grand from a $750,000 initial amount, you'd run out of money in 13 and a half years. Okay, everybody can see this on the left-hand side. Even though the market's going up 12%. So why is this happening? I spend a decent amount of time on this page with clients and have them feel the pain. So you do not want to go through this very quickly. You tell them and say, look, you started with 750. You have less money at the end of the first year because you only returned 4%. The next year, yeah, you got your 14% return, but you started at a lower base. So the $75,000 income, doesn't get you back to your 750. The third year, you have a nice close to 19% return. And now you're back over 750. So you're feeling a bit better. But the next 2 years is what crushes you. You lose 14% and you take your income. You lose 26%, you take your income. Now you're here having half the amount. And essentially your distribution rate is now 20% instead of 10. So even though we got 37 and 23% return, we're barely crawling out of the hole. One more bad year and you're done. So the reason why we call the sequence of return risk is because on the right-hand side, you have the exact inverse. So you see how this says 3, 14, 18, and down here, 3, 14, 18. So all we did was we reversed the order of those 20 years. So it's the same 12.77% average, but compounding and sequence changes everything. So on the right-hand side, you had all these up years. So you were able to build your nest egg to 1.6 million. In fact, at one point, you were able to build it up to 2.9 million over here. Even though you lost 26%, you're still fine. So we ran out of money in 13 and a half years over here. We had triple the amount of money. Okay, the reason why this is important is because the buffer years will always work mathematically in good times over here and in bad times. So, and again, we're not even talking about life insurance. We're just talking about a buffer in general. On the left-hand side, we buffered the year after a bad year in the market 3 times. So if we started out with retirement with 3 years of income to buffer, we were able to do so here, here, and here. And not only did we not run out of money, we had more money after 20 years than we started with. Okay, so we went from 0 to hero. On the right-hand side, we never ran out of money, correct? But we're still taking out 75 grand after a 5% return year, after a negative 5%, and after a negative 7. So we took out 3 times 75, which is 225. And what do we have? 2.9 million. So we went from 2.2 million to 2.9 million. And we only used 225,000 of buffer dollars. On the left-hand side, we went from 0 to 900,000 and we used the same 225. So strategically pulling out money from a non-correlated asset is paramount to people that want to retire without guaranteed income. These are people that still like thrill of the market and they want to look at their, returns. Some people like to use the other strategy, which I know is not the, context for today's meeting. The good thing is you get both when you own whole life, in retirement. So this is the more exciting, more nimble, more upside, but not guaranteed strategy. So this is one thing that I think is important. Any questions, Anthony?
Yeah, there's a couple questions, Jason. So just to recap, one, you've established, there's a couple math formulas here that you've used to articulate your story. One is you've established the distribution rate, and two is you've established the importance of the sequence of return using a mathematical formula of inverting the returns, right? Instead of average return, you're looking at order of return. So there's two concepts of math and arithmetic that drive you to your statement that whole life or cash value life insurance allows you to live better in retirement. So a couple questions. So from the audience. So one is, what is your response to those who say, hey, let's just look at the old fashioned bucket approach where I'm going to put cash in years 1 to 3, bonds in years 4 to 7, equities thereafter. How does this formula and strategy compare to the bucket theory?
So the bucket theory is actually the number one easiest theory to understand for people that are already retired or some older people. They just get it. So it's actually a behavioral finance strategy. So I actually like that strategy, but the reality of the math, and they actually go over this in the RICP curriculum in the American College. They actually say that if you take the bucket approach and you simulate it, if I go back to the Vanguard, it's actually the same math. So the bucket approach is actually no better than just having everything all in one. However, it does work because people compartmentalize and they say, look, I don't care. I'm not freaking out what the market's doing because my later bucket is out there. So they're only using the cash and they're essentially dumping every year from the further bucket into the middle into today. So psychologically, it really works.
So you articulated early in the presentation that cash can be used as a buffer asset.
It can.
Right. And whole life just happens to be a better option.
It can, but believe it or not, the cash and the bonds, if you were to use that, also follows this formula, Monte Carlo, because you're not getting the absolute guarantees on the growth of the cash value and the death benefit. And there's no death benefit for these other ones, right? You don't have, if you die with bonds, your spouse or kids get the value of the bonds. Same thing with the money market or CDs or anything. But with life insurance, they get a much larger amount and it's tax-free. So I just can't see a reason why anybody would want to not have whole life as the buffer if they're healthy enough to be able to get whole life.
Another question, Jason, from the field is when you're comparing the two economic powers versus the Monte Carlo is inflation adjusted and the two economic powers is not with inflation. How do we explain the lack of inflation planning on the buffer side or the economic powers story?
So that's a good question, and that can be addressed two ways. That they've actually showed inflation adjusted with the buffer, which lowers the distribution rate a little bit. But I actually like to answer it a different way, which is also behavioral finance. So Moshe Milevsky has a phenomenal presentation, and he's a professor in Canada on economics and life expectancy. And he basically talks about inflation in retirement and then the reality of how people spend in retirement. So I want everyone to listen to this because it's extremely important that we don't just try to plan a retirement that is inflation protected. And here's why. We talk about the go-go years, the slow-go years, and the no-go years. So the go-go years are typically 7 to 14 years, the first 7 to 14 years in retirement. Every day Saturday. We go on tons of vacations. We eat out. We might be spending more than we did in pre-retirement. Okay, so we actually need a pretty high income right after we retire. The problem is if you start with a really high distribution rate, you're at risk of running out of money if you're not using a strategy like this. Then you have the slow-go years. You're probably not traveling as much. You're spending less. So your actual inflation might be deflationary in those years. Then it goes high again, maybe in the late 80s and 90s, because you have the no-go years where there's a lot of health issues, long-term care. You actually might be spending more money, but you're not enjoying it. So it becomes the retirement income smile, where it starts out high, it kind of goes down, and then it goes up. There's a game that Moshe Milevsky plays, which I actually bought poker chips for. And when I was doing meetings in person before the pandemic, which I'm sure I'll do again soon, I gave people 60 poker chips and I had them write boxes down 70 to 75, 75 to 80, all the way up to 100. And I say, put these poker chips where you want to spend them. And that's it. Those are the only rules I give them. And lo and behold, it actually comes out as more of a deflationary. So they've put a decent amount of chips in the first 5 years and then some in the next. Some people kind of put inflation, but when you take the poll, almost everybody wants to spend more money in the early years. So I'm not even going to enjoy my 90s. So I have the money, or I'm going to die at 85. So it's very psychological. And I tried to combat the inflation with other math. It's really not a math question. It's a behavioral, and it took me a little bit to figure that out. So if anybody has any questions offline about dealing with inflation, I'd be happy to share with them that Moshe Milevsky presentation.
Okay, well done, well done. So you've established two mathematically proven strategies of distribution rate and sequence of return rate. Now, describe to me from a mathematical perspective, how do I start saving? How do I adopt? How much am I putting into the whole life? How much am I putting in equities? Where do I even begin? Conceptually, I get it, but where do I begin?
You begin just like with any other client. You got to know their balance sheet, their cash flow, and their retirement date with income. And I know retirement means something different for everybody, but the only way we can help somebody is knowing where they're currently at. Because if you give them a map, to Rhode Island and that's it, well, where are you starting? Oh, we're starting in Philadelphia or wherever you actually are. So we need to know someone's present position. Once we have their present position, it's pretty easy. But remember, the math is one thing, and then there's the reality of what somebody's going to do. So you have to actually go slow and essentially get them to realize that the current path that they're on is not too great. They might be on the path to a decent retirement nest egg, but they are not on the path for a retirement income. There is a difference. We're not saving money to just look at the pretty balances and be stressed out when the market pulls back 10 to 20%. There's a study from Towers Perrin that they did years ago that said the 1,065-year-olds all making 200 grand. The ones that had 80% or more guaranteed income lived 6 years longer than people that had less than 20% of guaranteed income. So you can look for that study. So if it's not exactly that, but it's pretty interesting. So people don't want to actually look, most people do not want to look at the stock market and see the ups and the downs. So hopefully that answered that, that question.
Yeah, thank you.
Mm-hmm.
From a planning perspective, and you've showed us a couple calculators. What is the software calculator you use? And again, this is not a software commercial. We have no affiliation with any software vendor, but Jason, what do you use in your everyday practice? So once you have gathered the data, you get to stroke a few keys and address the inputs and show a customer or a prospective customer, here is the roadmap. Here's how I'm going to get you there. And here's how we are going to determine how to allocate your dollars.
Yep. So I apologize if my almost 2-year-old's, crying in the background, but this is kind of normal for the pandemic. So when we look at someone's balance sheet and cash flow, we do a risk tolerance, but we're basically showing them, if you make this tweak, if they're saving 10,000 a month or 1,000 a month, this is what you should put towards investments and how much you should put towards actuarial science. I always show their current path. Then I show them 33% efficiency, 66% efficiency, 1-to-1, and then 2-to-1, meaning too much insurance. So it is not that whole life insurance is the magic behind this. It's the strategy, which is why I go back to that investment in life insurance person. They're missing the point. If they both understood that accumulation and distribution were valuable and they could be friends, they will help the client out a lot more. So it's one of my missions to get people to understand both the investment-centric people and they bash insurance. I want them to actually appreciate and value what the insurance people bring to the table and vice versa, because we try to be agnostic. It's a math formula. So if I'm meeting a 55-year-old that has no permanent insurance and they have $2-3 million saved, I might say all of your new cash flow should go to whole life, all of it, Why? Because you got no actuarial science. Your distribution rate stinks right now. We need to increase that. I've also met people that only have whole life, and I say, look, you're not leveraging anything. You're not getting enough growth. So I will tell those people to put into the market. So what I love about the program, about the strategy, is the goal is to have exactly 1 times your investments in death benefit life insurance at retirement. If you end up with $5 million in investments, you should have a tax equivalent death benefit. That will give you both opportunities to pensionize your investments or use the volatility buffer, which you'll probably have about 5 years of income in a buffer if you have that ratio. So that's when you know you're doing the right job if you're using this strategy, when your clients say to you at your annual reviews, how close am I to a 1-to-1 efficiency? That's when you know you've done your job. And it's so easy to make term conversions because you've already, insured them for human life value. So you can make sales in 5 minutes because they understand how this works for their entire life, their whole life.
Well said. So I'm going to just shift gears. You've nailed the concept, and you have nailed the mathematics behind proving the concept. Let's talk about product. How is Section 7702, or the change in Section 7702, and the retooling of multi-purpose whole life products refine your program and address consumer needs?
So it's really hasn't changed much. Well, it hasn't changed anything to the fundamentals, but what it does do is if you're using, say, a 2% product, Mass has a 2% whole life product, which if you look at it from a death benefit perspective, it's the most expensive product you can buy. It's like you get half the death benefit for the same premium, but your internal rate of return on the cash value looks fantastic. So if you're just focused on buffer years, it's great. So when they switched it from 4% down to 2%, different companies decided whether, they wanted 2, 3%, 3 3/4. It was different, between the carriers and what they chose. So the philosophy is exactly the same. If they want that 1-to-1 ratio, yeah, they're probably going to put more into premium for whole life than they originally thought. But we don't even discuss that. We really don't go into the illustration that often. We show them from this 50,000 foot of how much more income, they're going to have. So the buffers, it's definitely helped. The death benefit is lowered, but it is what it is. And the math is still the same. The 2 economic power, approach is the same. Also, if interest rates continue to go up and dividends look better, then you could easily continue to have higher death benefit in the later years because you have less net amount at risk now and more cash value. So you have less drag on the policies. So in the end, it really didn't change that much, but, other than maybe some upfront, nuances.
So in a 2% product, you can cater to the client who's more accumulation focused or buffer focused.
Mm-hmm.
The menu of product options has actually provided some flexibility to clients. So you're welcome to use a 3% product or an age 65 product or a 3.75% product. We've even seen if death benefit is more of a focus. So, 7702 has opened up a menu of options that we've never had before in the whole life space. So well said, but the fundamentals and the strategy just simply don't change. So, as we approach 12:50, I'm going to open this up to a couple of questions. We've done a pretty good job of addressing them as we go, but there are a couple lingering, Jason, that I'll give you the floor to share any closing thoughts on your presentation, and then do some cleanup with questions.
Yeah. So I will address the questions in 1 second because I think it's important that people see the math. They want something tangible. So 2 quick things. This is the probability of running out of money with certain distribution rates. This is basically the Vanguard retirement nest egg calculator, but in an Ibbotson chart. So all this is showing is years into retirement. Let's look at the 35-year retirement because maybe people are living a long time. In order to have greater than a 75% chance of survival, you really need to stay at 4% or less. Someone tries to take out 8%, there's going to be a very low probability of success. So if I go back to that scenario of saying that person that's okay with a high level of failure of looking at 6%, if they have 3 years of cash value life insurance, 3 years of buffer the day they retire, that's what this site is looking at. They could actually take 6% and have over an 80% chance of success. If they have 4 years, like all these numbers go up. So we're not saying it's guaranteed, but the more money you have on the sidelines that you can be nimble and go between the market and cash value, the better that you're going to do. So that's one thing I wanted to share. And then the other thing is, if I look at the dynamic future value calculator, this is also very, very, very powerful. And we look at, I'll just use one example of 1970. And if we have 30 years to look at, the system will show that there's a 14.84% return for those 30 years. So this kind of blows people away. If you invested $1 million in 1970 and you didn't touch it, you would have $46 million at the end of 30 years. Okay, that's cool. But now we're retired and we need to start taking money. So if people didn't know that the market doesn't average 14%, or if the sequence of return, they're saying, all right, I'm just going to take out 10%. So I'm going to take out $100,000. So if you take out $100,000, that's where you have these sequence of return risks and you actually run out of money in 13 and a half years. So then I start to layer the buffer years one by one. I don't even mention the cash value life insurance yet. So this is where I say, look, this first year was a down year. I'm going to go over here and I'm going to take out nothing. And then the next year, I'm going to go back to the well. So having 1 year of buffer went from failing in 13 and a half years to failing in 17 and a half or 16 and a half years. Okay, didn't move the needle that much. Let's go after this horrific year, and we're going to put in a 0. And then we go back to the well. This is 2 buffer years. 2 buffer years allowed us to run out of money in 23 years. Okay, we're getting closer. What if we put that 3rd buffer year in, which we'll put in right here. And the 3rd buffer year, let's see if we did the trick. We did it. We were able to retire and actually have $3 million instead of running out of money. But we'll do one more just to prove how powerful this is. After this negative year, I'm going to take out another. So remember, there was what, 3.2 million, 3.3 million? Let's see what it is now. 6.6. So every buffer year that you have saved at retirement will greatly increase the probability of success. It also allows you to take more risk in retirement. When I'm 65, 70, I don't know if I want to just sit mostly in, in bonds. I still want some equities because they are going to go up in the long run. But you better have a backup plan, and the backup plan is cash value life insurance. It's tied to the guarantees that eventually you're going to pass away and there's taxes. It's tax-free and tied to life expectancy. How can we not look at that? So I love this stuff. I'm passionate about it because I can mathematically prove really anything. And when you're arguing or having conversations, most likely they're talking about accumulation. They're not having the same conversation with you. And you have to acknowledge that. You have to say, yeah, you're right. However, this is what it's actually helping with. Now I can go to the questions.
Well done, Jason. So one of the questions actually is completely in line with what you just showed. Best practice, right? And every client, understand every client is different. How many years of buffer are you showcasing for your pre-retirees typically?
Minimum of 3. So three is what we would like. Now, the beauty of cash value life insurance is if you don't need to use those 3 years for a while, that bucket just keeps filling up. So 3 years of buffer at the beginning might actually mean you have 4 years. If you have 5 years at the beginning, you might actually be able to use that for 7 years of buffer. So there's a difference between static buffer years and dynamic buffer years. I don't even normally need to go into that with clients, but it is important to show them that in-force illustration and see how much more years they're going to get as the policy is kept up in retirement.
Thank you. Another question. Can you elaborate on actuarial science being able to distribute close to a 10% rate with whole life?
Yeah, so this is very important. I think the best way to describe it is with Social Security. So if you guys want to write it down, anything, hopefully we're taking notes, but Social Security is very, very powerful for anybody of any income. We understand that if someone's making $1 million a year, Social Security is not going to really make a difference to their retirement income, but the principles and the math behind it are important. So I always ask people, how much money do you need to have to produce a $35,000 income? I'll just go right to the Vanguard nest egg. And if I want $35,000 of income, I play with this number. Now I'm saying, how do you guarantee it? Okay. 35,000, that's only 96%. You might need more than that. Okay. I don't know exactly how much you would need to guarantee this. Okay. But it's over $1 million. How much money is actually in Social Security that's going to produce your $35,000 for the rest of your life? I pose that question and people are like, well, there isn't really money there. I'm like, yeah, you're kind of right. There's no money that's actually tied to your name. It's not like you have your own account when you call them up and say, hey, listen, stop sending me my $35,000 of income. Just give me a lump sum. That does not exist. They start laughing at you. But the same thing happens if you died 2 years into Social Security. You can't call them up and say, my spouse passed away, give me what I was supposed to because I didn't make it to life expectancy. That's not going to happen. Or if you live to 100 and you say, hey, listen, I owe you so much money because you paid me more than I should have gotten. No, that's the whole point. It's pooled risk. So even though there's no actual money for you, the actual amount tied to your life is roughly $400,000. So they have about $400,000 that's sitting there that's going to be producing, close to 8-9%. Why? Because they've pooled everyone's money together and they know how long you're going to live on average. So if you believe you are healthier than the average person, delay Social Security to 70 because you're going to get that 10% guaranteed return. That is not because the government is smarter than us with investing. It is an actuarial life expectancy calculation that you get an 8% guaranteed growth plus inflation. So 8 plus 2 is 10. You're not going to get that in the stock market. That is a distribution. That's an actuarial distribution. So in the reality is they have a lot less money there that's producing your income because it's an actuarial calculation. It's a pension. It's pooled risk. That's kind of the best way I can describe, that.
Well done, Jason. Thank you. And I think we did a real good job of addressing the questions on the fly. So at this point, we don't have any further questions. I want to bring, as we approach the top of the hour, I want to bring the call to a close. Jason, thank you so much for sharing. This call is recorded. You will see this within a couple hours, hit your inbox. If there's anything specific you'd like to see, particularly a request of Moshe Milevsky's presentation or any of Jason's contact info or tools, we'll be glad to share them as well. So everyone, thank you for joining. Jason, much appreciated. Always enjoy your time and presentation. Everyone stay safe and have a terrific day. Thank you.
Happy to be here. Thanks for the opportunity and good luck, everybody. Reach out if you need anything.
Bye-bye.